The economy of Spain. Despite great uncertainty, Spain's economy concludes 2022 with positive results. Since the commencement of the conflict in Ukraine, geopolitical and financial risks have increased dramatically, amplifying inflationary pressures and supply shocks that were already developing in 2021. Welcome to the channel, subscribe and follow for more. In 2023, it is anticipated a 1.3% increase in GDP and a 4.2% annual average inflation rate, both of which are still very high. Although at slower rates, employment will still increase, and while there won't be any significant corrections, we anticipate a slowdown in the housing market throughout the year. Similar to what we predict for 2022, the budget deficit will stay at about 4% of GDP. The current economic environment, which is characterized by the energy crisis in the EU and the geopolitical confrontation between Russia and Ukraine, makes forecasting more challenging. Numerous variables are pulling the Spanish economy in opposing directions as a result of the unstable and changing environment. But despite these challenges, we must nonetheless outline the key aspects we think will determine how the economy develops over the next few months. We must first comprehend the starting point for all forecasts. The Spanish economy has recently performed a little better than anticipated. The GDP figure for Q4 2022, which was released at the end of January, shows that the economy actually managed to avoid this decline and increased by 0.2% quarter-on-quarter. In late Q3 2022, the consensus of analysts had predicted that economic activity, which was plagued by inflation, uncertainty, and rising interest rates, would experience a slight decline in the closing stages of the year. Despite its modest size, this number demonstrates the Spanish economy's ability to withstand the effects of the energy crisis throughout 2022. It wasn't all good news, either. The economy is not immune to the current difficult circumstances, as seen by the weakness demonstrated by consumption and investment both dropped in quarter-on-quarter terms. The economy of Spain experiences persistently low productivity increases, a problem common to southern European nations. Over the previous 20 years, 2000 to 2021, apparent hourly labor productivity has only increased by 0.7% year on average, compared to increases of 1.1% in Germany, 0.9% in France, and 1% for the Eurozone. Three nations fared worse than Spain over this time: Italy, plus 0.3%, Greece, 0%, and Luxembourg, plus 0.1%, despite Luxembourg having a high level of production and a different economic system from Spain. Even if these discrepancies in productivity growth appear small, they have existed for a considerable amount of time, and Spain already had a significantly lower level than the majority of its European neighbors. Therefore, throughout the past 20 years, there hasn't been a catch-up effect. The disparity has really gotten wider. More specifically, Spain saw its productivity decline at the end of the 1990s, then enter a period of economic near stagnation that lasted roughly until the 2008 global financial crisis. This stood in stark contrast to the real GDP's average 3.1% annual growth rate between 2000 and 2008. This widening gap in growth between productivity and GDP at the time was a glaring hint that Spain's expansion strategy, which was mostly supported by wasteful investments and private debt, was unsustainable. In fact, the construction of buildings, which yields lower productivity benefits than other forms of investments, accounted for an inordinate amount of the high level of gross fixed capital formation, GFCF, during this time period. Additionally, the Spanish economy heavily relied on the number of hours worked to boost GDP development in the years before to the COVID-19 pandemic. The hours worked actually contributed up to 70% of GDP growth on average between 2014 and 2019, which is significantly more than what was assumed in France and Germany. This is due in part to the significant increase in employment throughout this time period, which is related to the economic recovery from the severe recession and financial crisis of 2008. In addition, although the rate of growth has slowed for the past 20 years, the contribution of hours worked to GDP growth has been rising for the past 3 decades. The contribution produced by investment, on the other hand, has decreased. Despite the fact that real GDP growth picked up during the 5 years before the pandemic, 2.6% annually on average from 2014 to 2019 versus 1.9% for the Eurozone overall, the difference in real GDP per capita continued to widen in comparison to Germany. It increased from a negative margin of 26% in 2000 to 30% in 2019 over the past 20 years. After the epidemic, this difference grew even more, reaching 34% in 2021. Spain's per capita wealth in the Eurozone was ranked 11th in 2021 out of 19 countries. This productivity deficit has been fueled by composition effects of activity related to a shift in the economy towards consumer services that are labor-intensive, especially in trade, retail, wholesale, catering and hotels and public services, education and health, while jobs in industry have decreased. Spain has experienced a more rapid and severe deindustrialization than the majority of other European nations during the late 1990s. The performance of the knowledge-intensive manufacturing and service sectors, which include a significant portion of jobs in information and communications, as well as professional, scientific, and technical services in particular, and other sectors whose sizes have increased over the past 2 decades but whose productivity levels are lower, now largely determine the health of the Spanish economy. Spain's underwhelming productivity improvements are not just attributable to this rebalancing of the labor market because there is also a sizable disparity within the business sectors themselves. Only 8 out of the 31 industries analyzed in 2018 saw hourly labor productivity in Spain exceed the Eurozone average, with an average productivity gap of 18%. Comparing the disparity to Germany and France, it is greater than 30%. Private sector firms are not solely responsible for Spain's investment deficit. GFCF in Spain's public sector has likewise significantly decreased. It decreased from 5.2% in 2009, when it peaked, to 2.7% in 2021 as a percentage of GDP. These investment levels are still among the lowest in the OECD when compared to national GDP. The first enables new industries and activities to arise and receive support, which eventually furthers the development and productivity of private enterprises. This suggests that there may be tremendous synergy between public and private sector investment. This long-term public investment suffered as a result of the fiscal austerity measures that Spain enacted in the wake of the 2 significant economic crises of 2008 and 2011. The Economic Affairs budget area, which includes the largest portion of governmental investments, was particularly affected. Despite a minor comeback in recent years, spending on this item in 2019 was roughly 60% lower than it was in 2010, the record high year, and was just above the level of the early 2000s. These budget cuts had an impact on every sector, but energy and transport were particularly hard hit, with the former declining by 65% from 2010 levels. All of the European Union's member states have an interest in a strong and prosperous Europe, therefore strengthening the euro area's architecture has been and continues to be a top priority. However, none of it absolves national governments of the need to remedy weaknesses in their own domain, as well as to encourage greater rates of growth and well-being for their own citizens. Today, we want to concentrate on how national policies have been crucial to recovery within the parameters of the euro area's established framework for policy. So let's take a minute to reflect on Spain's resilience in the face of hardship during the past 10 years and to recognize its tremendous economic accomplishments, most notably the recovery of its global competitiveness. In 2012, building had collapsed, output was falling along with real estate values, and the unemployment rate was above 25% higher for young people. Banks were failing, and while the government struggled to deal with the crisis, its financial situation was rapidly deteriorating. Fortunately, Spain's modest pre-crisis public debt provided a sizable fiscal buffer that enabled it to deal with the boom's effects. The Spanish government was unable to implement the typical counter-cyclical policy responses of currency rate depreciation and loose monetary policy due to Spain's membership in the European Monetary Union. I don't want to downplay Europe's eventual assistance in helping Spain recover. In 2012, the ECB played a key role in reopening the money supply taps, and the ESM contributed to the return of financial stability. These encouraging European initiatives had a significant role in spurring Spain's recovery. Spain's effective handling of the crisis serves as proof that monetary unions may adjust internally. For the Spanish people, the adjustment was challenging. However, Spain was able to stabilize the Spanish economy, which was in danger of crumbling in a storm. The economies of the world and Europe are now strong and recovering. The time has come to fix the roof while the sun is shining, as we like to say at the IMF. It is highly challenging to take risky actions during a crisis, as Spain did, and it might be much more challenging during prosperous times when there may be less political pressure to act. Thank you for watching. Follow for more.